So let me just repeat it. Okay. Strategy I'm about to show you is called the ICT, basically intercycle trading. And like once you have this, bro, like it's all done. It's all done. So I'ma just back test to a different
You said
area.
I into cycle.
Yeah, intercycle trading.
All right.
Yeah, but so it's ICT for short. I
All right.
wanna I wanna go to that NFP so that you could see what happened on that NFP as well. Just give me a moment. Ah, So basically, intercycle trading, bro, works with the time and the sessions from both London and New York. So we are basically like we are basically part of the London time frame because we are aligned with London in terms of the time. See that?
Yeah.
So what we do, we normally mark basically the beginning of everything and how everything starts. So you have to know that your London session. So please note these down. Your London starts from 8:30
Yeah.
till 6:30, and then
6:30 p.m.
no 4:30 p.m. Sorry, my bad.
All right. 8:30 to 4:30.
Yeah, and then after then it's the New York comes in from 4:30 till 1 till 1 o'clock in the morning, and then
Yeah.
from there it's just the Asian market until the London session. You see, so we basically have three major economies that are controlling the market. You see that,
Yeah.
and it's the Asians, which is your Chinese, is the London, it's the British, which is like your London, and then it's the New York, which is your American. See that?
Oh, yeah.
Okay, so what we have to do is we don't really trade the Asian market that much because the Asian doesn't have that much power, especially when we're dealing with Nasdaq, which is US 100. You see, the only thing that uh, the Asian market does for us in the US market is that it either helps the price to rush to a certain point, or it just collects orders, and brings in liquidity. That's the only thing it's there for. You see, so it's not really anything major for
Yeah.
us. You see, so how it happens, we're looking at these two sessions only. We're looking at the London session following into the New York session. You see, and those two sessions are going to give us a lot of insights when it comes to New York indices. So what we have to do is we're first going to mark where the open is, where the London open is. So as soon as 4:30, just always put in your wedges so it looks proper. And then you mark the first candle. You mark whether it's high or low, depending on if if it's a bullish or bearish candle. And then from there, you just mark it as the London open. London open. Okay, so now you have the London open. So usually your London open will be like your median to the fluctuation that is happening in the market. See, and then
Yeah.
from there, you are waiting for this market to create two sides of liquidity. See, so when it comes to liquidity, we have two sides of liquidity. We actually have three sides of liquidity, which is your buy
Yeah.
side liquidity, sell side liquidity, and then you have your neutral liquidity, which is when the price reaches equilibrium. It's like your neutral liquidity. Basically, no liquidity at all, which is your equilibrium. So
All right.
once you started marking there, you're gonna have to also mark your London low. So this right here was around about the London low, yeah, around this point. This was your London low. So you see, they started off the London low here first. You see, and then the market went up, and then they got the high. So as time went, they went to come and also create a new low. So as the session goes, uh, the low won't be the same. It can change at any time, due to whatever. If it can be also be results that are stretching out the price. See that? So
Yeah.
then we're gonna mark this as our London low. So now we know where the low is, which low side of the London is. So since the low is there, we know that there is sell side liquidity. So it's the sell side. So it's the liquidity on the selling side. Wait, right. Is the music disturbing?
Nah, I hear you loud and clear. It's cool.
Oh, okay. So it's the sell side liquidity. So we've marked it here that okay, the liquidity is here on the bottom side for the selling side. So all sides all have liquidity at the end of the day. We're
Yeah.
not biased to any side. So okay, we marked that. Now we see this was the high. This point here was the London high. You see that? That's the highest point in which the London market could go. So we have London high. There's the London high. So now we basically have all the three elements uh, in this session, which is our high, our median, our low. See that? And then we have our buy side liquidity here. The buy side liquidity. So this buy side liquidity is where we have our money here on the buying side. So we know that on the sell side liquidity is where the market will go and collect the market if it's on a selling point. And then we know the buy side liquidity is the liquidity which will be collected if it's on a buying point. You see that? So
Yeah.
on each side there's liquidity. See, so it can also be a situation where you have your high where the open is. See that? You can also have those situations. We'll be back testing some more, so you will see that. So how this works is that around about your 3:30, which is an hour away from when the London when the New York opens,
Yeah.
we're gonna wait for the market to take out each one of either side of liquidity. See that? So we're gonna wait for one side of liquidity to be taken out in the New York session as soon as the New York session starts. And there's always a trigger when it gets to 4:30. When it gets to 4:30, you will usually start seeing the market getting a bit volatile, and start moving with big candles and stuff. That's because when it comes to the New York session, they're the guys that put in most of the money into the market because this is a New York index. See, US 100 is an index which is backed by a lot of technology companies that are from America. So you have the US 100 is backed by your Apple, your Microsoft, your Tesla, your Amazon, all of these technological companies. So it moves a lot when the New York session starts because most of these, or actually not even most, all of these companies are based in America and it's an American index. So you won't find a company that's like outside of America uh, backing up the US 100. You see that.
Oh, yeah.
So as you see here, I think this is around about 3. The market came down after creating its high. The market came down. So when it came down, it was coming down to set up to take out this liquidity here. So you see it rushed, it broke down this low and then created another low. So if we can go in closer. So around about these times, these are the most critical times and you have to monitor these candles. So see that once it created the low, it went up as soon as the New York session started, it got took out. So I'm gonna just delete this so you can wait, let me shift it a bit. So you see this candle. So as soon
Yeah,
as this is a 430 candle here, it's a 430 candle.
yeah,
So as soon as the New York came in, they came in and took out this low. The price was already there. So if the price already opens where it's close to whichever liquid side, it's gonna rush and take out the closest liquid side. You see that? So in this term, the
yeah,
closest liquid side was the sell side, and it will come and take it out. It pinned once, it pinned the second time, and then the candle left. See that? So once it leaves, after taking out the sell side liquidity, it will take out the opposite side of the liquidity. So that opposite side of the liquidity is where we basically enter our trades. You see, that's where we are looking for our entries to be because they've already taken out the sell side liquidity. And we know that the
yeah,
market basically rushes to take out all the liquidity out of the market. So in this case, it came in, it bounced, took out that by 6:30, by 4:30. The market rose, and then it rose to take out the London high. You see that? So
yeah,
this is where we enter our trade right here by 4:30 because it's already close to that side. You see, and then this is where we
yeah,
would have entered our trade here in order for it to take out that London high. You see, and then
yeah. I
once it takes out the London high, that is basically our TP, our take profit. And then
yeah,
you can see after it took out the high, it did a head and shoulders, and then the price came back to where it was. You see, but the major movement that we're looking for is the opposite side liquidity of the one that gets
yeah.
taken out first. You see that?
I
So that's basically how the strategy works, and how it lines up. So we're gonna try and just take let's take this day, the day before. It's the day before. I think when was this? I think this was Thursday. Is it Thursday? I think it was Thursday. Yeah, it was Thursday. So we're gonna do the same thing. We're just back testing. So this is how you would back test, most of your setups. Go to the previous market day and see what lined up. So here was Friday. So Tuesday, we're gonna start with Tuesday. So like I said, we don't really pay attention to the Asian. So we're gonna start here by our 8:30. So there's our 8:30, and then gonna place, gonna mark the open, and then open, and then here's the low. So the London low
You
short
said
itself.
8:30. Okay, so this is the London.
Yeah, this during the London. So it's until, was it 4:30? Yeah, 4:30. 4:30 was somewhere around here. 4:30 was somewhere here. So then we got our London high there. So the London high was basically where it was closing.
At 4:30.
Yeah, 4:30 London high. So this was the London session, yeah. So we're just gonna mount it. London session. Then we're entering, and then this be the New York session. All right, so that be the New York. So as you can see here, once the price went up, it left this low, went to go create the high. So after it created the high, it punched in more into the high. So this type of action here, this is what we call inflation when the market is being inflated. So when the price is being inflated, that means that they will throw the price on top. So what happens usually when there's inflation is that when there's inflation, there's also a compound. So that means that
Yeah,
wherever the market is being inflated in, the opposite side will like compound. You see that? So once, oh, sorry about that. Once the price went up, it kept going up. So it inflated until an order block, and then it got a reaction. So this is the order block. So
yeah,
you can see that actually this market was part of a trend, an upward trend that was going up. So when there's a trend anywhere, an upward trend or a downward trend, it can be that liquidity compounds and they can end up like leaving certain size of liquidity, but even them leaving it means that they are still valid because it's still there, and that is probably liquidity they'll come and take back after some time, if they are trend in the market or if there's a heavy inflation, you see. So also in aspects, it doesn't mean that every day they're gonna keep taking out the opposite side of the liquidity, because it can be that that day they are compounding the liquidity. You see, and when they compound the liquidity, that
yeah.
means that they're flooding in a lot of money into the market. So once it came out, the New York came out and it pinned on top. Uh, Let me mark the close. Yeah. So the price went up, got inflated, and then reacted outside the order block. Then we got a double top. We got a double top, and then the market closed here. So it didn't take out this low. You see that this low was still
Say
valid.
again.
I said it didn't take out the low. It didn't take
Okay,
out the
yeah,
low, but it took out the high here. Took out the high
yeah.
and it inflated above the high.
So
It
whenever it
came.
takes out the high, it's an inflation.
No, 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 not necessarily when it takes out the high, it's an inflation. It can be that maybe in that period of phrase or phase, the market is being inflated, and then
Yeah.
they can leave the sell side liquidity for that day and not come and take it if they're taking out the high, or they can even leave the buy side liquidity if they just gonna continue on a trend, which either a buy trend or a sell trend.
Okay.
You see
Okay.
that? So in this term, they will still continue for a buy trend. They inflated it and then brought it back down to here, but then they didn't take out the London low. They left the London low. See that? And then the Asian time came. Then and then this was Friday, which was the Friday we went through this. So after that Friday, you see they took it out on the Asian side. They took out that liquidity using the Asian side. Like I said, the Asian market is usually used to rush a price somewhere. You see, make sure that it rushes somewhere, and then it got taken out. So at the end, they still did come back for that liquidity. So it just shows that the liquidity was still valid. It's just that they compounded it for the next day, and then they took out this low here, so it didn't compound with that low. It was just that low there, and then it came up. So when it came to Monday, I think it's Monday, they took it out on a Monday. See, they took out that sell on a Monday, and yeah, took out that sell on a Monday. So that liquidity was in fact taken out. You see that liquidity was taken out.
Yeah.
So, and then it came to this week. So we're just going to go through a little bit of this week. Let me just clear out some of these because it's looking a bit messy. So then we're gonna come into, well, usually Mondays are really like slow days. Nothing really major happens. So this is after the Friday. Yeah. So here's the New York close. So I'm gonna just mark that New York close, and then we'll mark the Asian. Wait, sorry, man. I'm making a mistake here. Let me clear out everything. It's getting a bit confusing. Yeah, Monday was the 6th, right? Yeah, Monday was the
Monday,
6th.
yeah, was the 6th, yeah.
So there's Monday, 30, 30. Now that's Asian. These are London, and then American. Yeah. So yeah, bring it more to this side. So yeah, this is how it is. So same thing, same drill, same scenario. We have to mark where everything is. So we have to mark where the high is. So like I said, in some situations, your high and the open can coincide. So and then open slash high. So it's also the open and the high. This level here, you see, there's also the open and the high. And then they came to create another low here. Yeah. Let me go within. Let me go within. Stretch it a bit. So yeah. So here's our London low. Our London low is isolated on its own. So here's the low here. See that? So
Yeah,
let's
yeah,
deduce. Let's deduce. So we saw our open. Our open is the same as our high. So we let the market do its thing during the morning, during the London session. We let it do its thing. We check up on it. Say 3:30 is usually the right time to check up on it. So in this instance, you can see that and most of the time the market will be left in the middle of the market, you know. And then
yeah.
once it left in the middle, it was when it hit 6:30, the price was searching for which liquidity it should take out. You see that? So the price rushed up, came up, and what did it do? It took out this buy side liquidity
Uh-huh.
first. You see, so
Yeah,
throughout this time here, it was working to take out either side of liquidity. So it decided to go take out the buy side liquidity. Once it took out the buy side liquidity, instant reaction. You see that we had a sell. It sold off to do what? To come take out the London low. And yes, it did
yeah.
take out the London low. It took out the liquidity and it took out the London low. So that's basically our entry. See just that this reaction here. It's already
Except it was, yeah, it was going down.
yeah. Once it took out that side, it went down, took out the low, you see, and then we close. As soon as it touches the low, we close our entries, we leave the market. You know, we're not gonna be greedy and want to hold because You see that after
Yeah.
that, it pinned back up. You see, it pinned back up
Yeah.
and it went to go retest these levels because it can retest these levels. It can do that for a number of reasons. Maybe it wanted to also take out some scalpers that entered. You see, that's why it's quick. It's always nice once you get in by the side that got took out and you're rushing for the opposite side. Once it reaches there, you should get out of the market and take your profits. You know, if there's more entries, you'll enter again, but it wouldn't be necessary for you to enter again if you already took your profits. So it came back up and then it did a double top formation. You see, so it was given a lot of opportunities this day around that level. It took a double top formation and then the price started going down slowly. So then this was just a drag off. And then the market closed in the middle because both sides of liquidities were taken out. The market is satisfied, and then it will just cruise to the middle. See that?
Yeah.
Yeah. So it's pretty much just straightforward. See, and then let's go into the next day and see what happened the next day as well. So I'm gonna clear out these just for that clarity, and then we have
So you always mark the equilibrium
yeah, it's
when you're
always
putting in.
come again.
So where do you always put in? Where do you put in the equilibrium?
You put the equilibrium is usually where the open is. You see, that's how we measure where the equilibrium is where the open is. Because then again, it's also theory. You know, it might not be the exact middle between the buy side or the sell side liquidity.
Okay.
You know, yeah, it could either
Yeah,
be
that's what
close
I
to
had to
one.
understand.
Okay, it could be close to either one. You know, it just all depends on the
Oh yeah.
situation. Yeah. Okay, so then we're marking New York till the New York 4:30. Okay, there it is. So let's start marking. Like I love marking these points, bro. They just also make the chart look more structured, you know.
Much more straightforward. Yeah,
Yeah, much more straightforward, you know.
and easy to read and shit. Yeah.
Uh,
I'm saying it easy to read.
yeah. It definitely becomes easy to read, you know, other than when it's just sticks and candles, you know.
Yeah.
London high. So we marked well London highs. Yep. And we are low. London low.
And it only matters to mark the London market only.
Yeah. That's all that matters. Okay, we're gonna get kicked out soon. So let's
I
just close it here. We'll jump back in. Just give me about five minutes just for the video to convert, and then we'll jump back in.
oh yeah. Also, I checked on Telegram. Yeah, you can send that other recording again because I don't see it there.
Okay, now I'll send it again after this meeting.
Oh yeah.